Welcome to the deep dive. It's Monday, May 19th, 2025. You're here because you want to get up to speed quickly and really understand what matters. Today, we are diving deep into investing in gold. We've got the latest news, forecasts from some big financial players, and a practical guide for investors. Our mission, simple: give you a clear view of the gold market right now, where it might be going, and, well, how you might think about getting involved. All the essentials, none of the fluff.
All right, let's get straight into it then. So as of today, Monday the 19th, the MCX gold price over in India is sitting at 93,398.000 per 10 grams. That's from the Economic Times. But what's really caught everyone's eye is the momentum, the recent surge.
Surge, how much are we talking?
In just the first quarter of this year, Q1 2025, gold prices jumped nearly 20%. Investing News Network reported that.
Wow, almost 20% in 3 months. That's a big move. What kicked that off?
Well, the main thing seems to be the global financial market uncertainty. It really picked up after Donald Trump's inauguration and, the sweeping policy changes his administration brought in.
Okay, so instability drives investors towards safety.
Exactly. When things feel rocky, people look for safe havens. Gold's always been a classic example of that.
Is it just a general feeling, or are there specific things making the market nervous?
Oh, definitely specific things. Geopolitical instability is a huge one. Remember those tariff threats Trump aimed at Canada and Mexico earlier this year?
Right, that caused quite a stir.
It did. Investing News Network really flagged how that destabilized markets, and gold benefited directly. It even led to physical gold actually moving into U.S. depositories, people wanting it somewhere they felt was safer. And then you add in the collapsed ceasefire between Israel and Hamas, more U.S. military activity in the Middle East. It all just ramps up that demand for safety.
Okay, so geopolitics is definitely a major piece of the puzzle. What else is pushing gold higher?
Another really big factor, maybe even bigger lately, is central bank buying.
Central banks.
Yeah, this trend really accelerated after Russia's assets were frozen back in 2022. Goldman Sachs pointed out something interesting. Institutional demand on the London OTC market jumped fivefold after that.
Fivefold. The London OTC, that's the big institutional market,
Yeah.
right? Where they trade directly.
Exactly. Over-the-counter, large institutions trading directly. A fivefold jump there is, well, it's massive.
What does that signal, such a huge increase?
It suggests, maybe a strategic shift. Countries possibly looking for alternatives to traditional reserves or hedging against maybe future sanctions. And we're seeing it in the numbers just from Q1 this year. Uzbekistan bought 8 metric tons. The People's Bank of China added another 5 tons they now hold, 2,285 tons total. Kazakhstan bought 4 tons.
Wow.
And big picture, Investing News Network noted central banks have bought something like 10,000 metric tons since late 2015. It's a sustained trend. Diversification, security.
Okay, so massive central bank demand. How does U.S. monetary policy fit in? The Fed?
Right, the Fed. This is crucial. Goldman Sachs, Blueberry. They both expect the Federal Reserve to start cutting interest rates this year, 2025.
And rate cuts are good for gold. How does that work?
Well, think about it. If interest rates go down, holding something that pays interest, like a bond, becomes less attractive compared to something that doesn't, like gold. Gold doesn't yield anything, so lower rates reduce the opportunity cost of holding it. Plus, lower rates can sometimes weaken the U.S. dollar.
Ah, and a weaker dollar makes gold cheaper for buyers using other currencies.
Precisely. Goldman thinks we'll see 2 rate cuts from the Fed this year.
Makes sense. Lower returns elsewhere make gold look shinier. What about inflation? Is that still part of the story?
It is, yeah. Blueberry mentioned the potential for inflation to spike again. Gold is, traditionally seen as that hedge against inflation. If your money buys less, gold's value tends to hold up or increase. So lingering inflation worries. That adds another layer of support.
Okay, geopolitics, central banks, Fed cuts, inflation. Are there any new demand sources popping up?
Actually, yes. Something interesting developing in China. Investing News Network reported on a new pilot program. It lets Chinese insurance companies invest up to 1% of their assets in bullion.
1%. How significant could that be?
Well, considering the huge size of China's insurance market, even 1% could mean a pretty significant new flow of money into gold. Definitely something to watch.
Okay, so it sounds like a perfect storm of factors, really. Geopolitical risk, heavy central bank buying, expected rate cuts, inflation fears, potential new demand from China. Given all that, what are the experts actually predicting for gold prices for the rest of 2025?
The outlook is pretty bullish across the board. Goldman Sachs, like we mentioned, they've bumped their forecast up significantly. They're now looking at $3,100 per troy ounce by year-end.
$3,100. What was their old forecast?
It was $2,890, so quite a jump. And they even have scenarios pushing it higher, maybe $3,300 if uncertainty stays high, or $3,200 if central banks keep buying strongly.
That's a strong statement from Goldman. What about other big banks? Is there a consensus forming?
Generally, yes. Blueberry reports that major banks mostly see gold hitting new highs, maybe $2,900 by early next year, with $3,000 as a longer-term target. Citi agrees, basically. They see strength through 2025, possibly hitting that $2,900, $3,000 range early in 26. JP Morgan is also supportive, though maybe a touch more cautious. They're projecting $2,500 to $2,775 by the end of this year. Still strong, but not quite as high as some others.
Okay, any other notable forecasts?
Yeah, Commerzbank raised theirs to $2,600 by mid-year, but they see a little dip back to $2,550 by year-end, citing inflation impacts perhaps easing slightly then. Wall Street sentiment, broadly speaking, seems very positive. Talk of approaching $3,000 soon. Commonwealth Bank of Australia, CBA, they're talking another potential 10% rise from current levels, maybe hitting US $3,000 by the end of 25. And then you have analysts like Ed Yardeni, who sees a possible 50% upside, $3,500 if inflation really surges again. That's a big if, but it shows the potential some sees.
50% upside, wow. Where does that leave us right now, price-wise?
Well, Blueberry noted the XAUSD index, that's the COM gold spot price, has been getting close to $2,640. The all-time high is just above that, $2,685. So suggests we could see a break above $2,700 fairly soon.
And overall return potential?
There's even a specific prediction mentioned by Blueberry for a potential 12.5% ROI on gold investments over the next year.
Okay, so the forecasts are definitely pointing upwards, driven by all those factors we discussed. Now, for you, the listener, who might be thinking, okay, this sounds interesting, maybe I should consider gold. How do you actually do that? What are the practical ways to invest?
Right. This brings us to the investor's guide part. It lays out the main options pretty clearly. First, there's direct ownership, buying physical gold, gold bars, gold coins.
The classic way, holding it in your hand.
Exactly. It's tangible. But you need to think about secure storage, right? And insurance. Plus, dealers charge a markup over the spot price. And liquidity can be an issue. Selling a big gold bar might be harder than selling smaller coins, for example.
Okay, so physical gold has its appeal, but practical hurdles too. What about easier options, maybe for smaller investors?
Definitely. For most people, gold ETFs, exchange-traded funds, and mutual funds are probably more practical.
How did those work?
Well, an ETF trades like a stock on an exchange. You buy shares, the fund itself holds physical gold or sometimes futures contracts. So buying a share gives you exposure to the gold price without you having to store the actual metal. They tend to have lower costs, lower expense ratios, the guide mentioned around 0.61%, as typical for some ETFs. Mutual funds offer similar exposure, sometimes investing in a mix of bullion and mining stocks.
So much easier access, potentially lower costs, no storage hassles. Seems like a good starting point for many.
Generally, yes. The guide suggests these are often the easiest and safest ways for the average person to get into gold investing. You can often start with just the price of one share.
What if someone's a more experienced investor, looking for maybe more leverage or direct market play?
Then they might look at gold futures and options. These are contracts. A futures contract is an agreement to buy or sell gold at a set price on a future date. Options give you the right, but not the obligation, to do so.
Sounds more complex, higher risks.
Definitely higher risk. You're dealing with leverage, meaning small price movements can lead to big gains or losses. Commissions might be lower, but the contract sizes can be large. It's really for people who understand these markets well. The guide did note, though, that futures can be the cheapest way to invest if you're dealing with very large sums.
Okay, so physical, ETFs, funds, futures options, any other ways to play the gold theme?
Yes, investing in gold mining companies. Buying shares in the companies that actually dig the stuff up and refine it.
How does that compare?
Well, their fortunes are obviously tied to the gold price, but it's not a pure play. Company performance also depends on, their mining operations, management skill, the political stability where their mines are located, lots of other factors.
So it requires more company-specific research.
Exactly. But it can sometimes be seen as a slightly lower risk way to get gold exposure compared to something like futures, because you're investing in an operating business.
Right. And finally, jewelry. Does buying a gold necklace count as investing?
Well, it's enjoyable, but as an investment, not really ideal. The price you pay for jewelry includes a big markup for the craftsmanship, the brand, the retailer's profit, much higher than the actual value of the gold content.
So fun to own, less effective for pure investment returns.
Pretty much.
Okay, so let's just recap those key takeaways on investing from the guide.
Sure. The main points are gold is often used as a hedge, right? Against political trouble, inflation. It doesn't always move with stocks and bonds, which is good for diversification. Many advisors actually recommend having some commodities, like gold, in a portfolio for that reason. Manage overall risk. But the best way for you, it really depends. Your budget, your goals, how much risk you're comfortable with.
So no one-size-fits-all answer.
Not at all. Maybe larger investors look at bullion. Average investors might find ETFs or mutual funds make more sense. Easier access, lower minimums. More aggressive experienced investors. Maybe they explore futures and options, understanding the risks involved. And mining stocks are another route, requiring that company research.
And the bottom line.
Do your homework, understand the risks, understand the cost, whatever method you choose. That's crucial before putting any money in.
Right. So bringing it all together then, it really feels like we have this convergence, doesn't it? Strong central bank buying, geopolitical tensions aren't going away, the Fed looks set to cut rates. It all seems to paint a pretty positive picture for gold through 2025. Lots of forecasts pointing higher, and we've walked through the different ways you can think about getting exposure: physical gold, ETFs, mining stocks. The key, as you said, is figuring out what fits your own situation, your own risk tolerance.
Absolutely. Which leads to a final thought maybe for you to mull over. With all these global forces aligning, could gold be starting, a new long-term bull market? And if so, what role should it play in your investment strategy going forward? Something to definitely think about.